Well, hi everybody and welcome. We're a few minutes late because of good old technology. Um, Last week, we talked about unsecured business credit lines, and I know quite a few of you were attending the webinar on the concierge credit service. So you probably learned quite a lot. Today, we're keeping somewhat in line with that subject, and we're going to talk about 5 ways to build credit, uh, which is important, especially when you want to invest in real estate. Um, so, without further ado, and because we're a few minutes late, let's jump right in. Brian, tell us a little bit about FICO scores.
Sure. So there are a few different types of credit score out there, but the most commonly used is FICO, which is created by the Fair Isaac Corporation, hence the term FICO. And these are used by most of the lenders out there and credit card companies. Credit scores range from 300 to 850. In practice, you almost never see credit scores below 500, and it's rare to see credit scores above 800 as well. So a credit score in the mid to upper 600s is, average to good. Anything below like 650 is fair. Below 600 is bad. And then above 750 is great credit. Over 800 is outstanding credit. So hopefully that gives you a sense of the credit involved. So the way that FICO calculates these scores, here's how it breaks down. So your payment history accounts for the largest proportion of your credit score. So if you make your payments late every month, or ever for that matter, you're going to have bad credit. I mean, that's what it is. If you make your payments on time every month, that goes a long way in helping you to establish better credit. So your payment history accounts for 35% of your credit score. Now, the next largest factor that impacts your credit score is the total amount of debt that you have versus your total credit limit. And this is particularly impactful for rotating credit lines like credit cards. So,
right. And that's per credit line.
Yeah, so it's basically the ratio of credit that you have, like the total credit limit you have, versus the amount that you actually use. And that's calculated as a percentage. So if you have a credit limit of $1,000 on a credit card and you use 250, you have a credit balance of $250 on that, then that's a 25% usage ratio, which is okay. Anything under a 30% usage ratio is pretty good. So that's a magic number with the credit bureaus is 30% credit usage. You want to keep your balances below that. All right, the next largest factor that impacts your credit scores is the length of credit history, the average age of your accounts. That accounts for 15% of your credit score. The older your accounts, the better. Older accounts mean that you have a more established credit history, whereas if you just opened an account last month, you don't have a whole lot of credit history to speak of. So the average age of your accounts plays a role in your credit. Older is better. And
what about, I'm going to ask, with credit inquiries, I know this question comes up a lot, so I'm going to have you answer it. Soft hits and hard hits. Can you describe the difference between them?
Sure. So credit inquiries make up 10% of your credit score. And those, first of all, they disappear after a certain amount of time. They disappear entirely within 2 years. They stop impacting your credit score within 1 year. So, it's a tiny ding against your score. We're not talking about much of a movement here on your score. But to answer your question, the difference between a hard inquiry and a soft inquiry is that a soft inquiry is initiated by the consumer and does not ding your credit score at all. So, for example, the tenant screening reports that landlords run through our website, those actually get approved and authorized by the tenant, by the applicant. So those are soft credit inquiries and do not hurt the tenant's score at all. Mm-hmm. A credit card company or a mortgage lender, for example, runs your credit report unilaterally. That is a hard credit ding, and that does hurt your score a very little bit, but again, it's temporary and it goes away within a year. So it's not the end of the world, but it can hurt your credit score a little bit. And then finally, the last factor that impacts your credit score is your credit mix. So the different types of credit that you have. The credit bureaus like to see a diverse range of credit types. So credit cards and maybe a car loan or a personal loan or a mortgage loan. So, the more different types of credit you have, the better. Although that being said, you also don't want to have high balances on any of those, because what we talked about for the second factor, your credit utilization ratio. So,
Right. And say you had a divorce or an illness or whatnot, and your score is a little low, or layoff or whatnot, or COVID. What are some things that you can do to pop that score up a bit?
well, first and foremost, you want to check your credit score, your credit report regularly, and your credit score for that matter, because the credit bureaus get it wrong all the time. I mean, they're processing billions upon billions of transactions every single day, and they're going to make mistakes sometimes. So you want to look for errors on your credit report, and if you see any errors that are hurting your credit, dispute them. And by
Mhm.
law, the three credit bureaus, the main credit bureaus, Experian, Equifax, and TransUnion, they have to reply to you within 30 days. There's a whole streamlined process that they have to honor by federal law. So they have very simple, user-friendly ways for you to dispute any errors. Each one of their websites have a place where you can do that. So you want to monitor your credit report at least once a year and look for errors and then dispute those errors. And that is actually the fastest way to improve your credit score, is to fix errors on it. Now, if your credit is bad because of things that you did and not because of errors, that's a different story. The first and foremost thing that you must do is you must pay your bills on time, in full, every single month, no exceptions. If you
Right.
make payments, it's going to ruin your credit. Period. That's just what it is.
Now,
Now,
with that being said, there are attorneys and uh, companies or whatever that will help you to clear up some of those things. And you'll have, like, Lexington Law is one of them, but there's a bazillion out there, and there's attorneys that can actually, because unfortunately these credit companies sell your accounts off for dollars, pennies on the dollar, and these companies will come after you with a fervor, and there are regulations they have to follow, and often they don't. So it's not a bad idea, even if it was your fault, to check with an attorney or a company like Lexington, just to see if there's things that you can do, and with their help, because I've heard it, and I've seen it myself. I went through a divorce, and I had help from an attorney help me to stop some harassment and whatnot.
absolutely, absolutely. And the next thing you can do, the next fastest way to improve your credit is to pay down your credit card balances below 30% of your credit limit.
Hmm.
So again, if you have a credit limit on your credit card of $1,000, get that balance below $300. So get your balances below 30% of your total credit line limit, and that will boost your score instantly, or at least the next within a month.
Hmm.
Sometimes there's a month-long delay here, but that's the fastest way, other than fixing errors. Paying down your credit card balances or other rotating debt balances, the fastest way to improve your credit. Now, another thing that you can do along similar lines there is you can ask for a credit line increase, which
Hmm.
can achieve the same result, right? So if your credit line is $1,000, and if you have a $500 balance, and if you get your credit card company to boost your credit card limit up to $2,000, then suddenly that puts you below that 30% utilization ratio, right? So asking for a credit line increase can achieve the same result of getting your balance below 30% of your total credit line, your
Now,
credit limit.
does getting or asking for an increase, is that a hard hit or a soft hit, or does that affect your credit score at all?
If they run your credit report, which they probably will, then yes, that will be a hard credit inquiry, most likely. But again, those are temporary and they're very small. It might ding your score, a couple points or something, but it's not going to make or break your credit score.
Gotcha.
Now, finally, some people have not established much credit yet, which is different from trying to fix bad credit. Some people just haven't had the chance to build any credit at all yet. College students, for example, young people, immigrants, people who just haven't had a chance to create a credit history yet. And the strategy for them is a little bit different. They want to open some credit accounts to start establishing credit. One thing they can do is open a credit card account, of course, that's easy enough. Or if they have trouble opening a credit card because they don't have any credit history, they can open a secured credit card where the credit card company holds collateral from you, usually cash. They'll have a certain amount of cash that they hold as collateral, and then they'll give you a credit card with a balance limit up to the amount of cash that you gave them. And but it works. So that they still report it as a credit card. It's not a debit card. They just hold that cash reserve in case you default. And then, after you have that for a year, you can graduate up to an unsecured credit card, like a big kid. So another thing that you can do to build credit is you can get a credit builder loan, which is, it's not actually a loan, it's a misnomer, but it's reported as a loan to the credit bureaus. So what you do is one of these companies, you would go to them and you agree to make monthly payments to them for a certain term, 1 year, 2 years, whatever. And they set aside your money for you. And at the end of the loan term, they give you back your money minus a small fee for their trouble, right? But they report your monthly payments as if it's a loan, as if it's an installment loan. So,
which helps with the mixed bag. So you don't just have credit cards, so you also have a loan.
Exactly. So, it doesn't cost you much. You might pay $20 or something total for for this service. And then over the course of the next year or two, you build credit through it and you get the money back at the end. So it's a great way to build your credit profile if you do not have any credit history established yet. And one final point here is, let's talk mortgages against rental properties, because we're all real estate investors here, right? Property managers. So 1 or 2 mortgages on your credit report helps your credit. 3, 4, 5, 6, 7, 8, 9, 10 that is not going to help your credit at all. It's going to hurt your credit. And most conventional mortgage lenders, they put a limit on the number of mortgages reporting on your credit before they stop lending you mortgages. So for most lenders, most conventional mortgage lenders, that's 4. So you can have up to 4 conventional mortgage loans reporting on your credit, and then you can't take them out anymore. You have to go use someone like a portfolio lender who keeps their loans in-house and doesn't report these loans to the credit bureaus. But there is a limit to how many conventional mortgage loans you can get on rental properties before you get cut off by your traditional mortgage brokers and lenders.
Very cool. And we have a link to our loans page, and there's a ton of information on these type of lenders.
Yeah, we've compiled a bunch of different portfolio lenders that specifically work with real estate investors. They do not report your loan payments to the credit bureaus. It's all held in-house. So great resources. And we have an article with much greater detail on how to improve your credit score, particularly as a real estate investor, since it does impact your livelihood. I mean, the better your credit, the easier time you're going to have financing your rental properties.
Absolutely. I think people think too that
we appreciate it.
Oh, thank you. Like I've heard this. Oh, we have plenty of cash. We only need a small mortgage, so we'll be okay even if we have bad credit, which isn't always the case. So really protect your credit.
Yeah,
it's
and
better than cash.
You never know when an emergency will hit and when you'll need access to more capital. And at that point, having good credit can be a lifesaver for you, literally. So Tim says, all 3 of my properties will be under my LLCs very soon. Tim, glad to hear that. I can help with asset protection and in some cases with tax protection. But yeah, so if Tim, if you not most conventional mortgage lenders will not lend to LLCs. Portfolio mortgage lenders will lend to LLCs, just for reference. So, all right, Deni, is there anything else you want to cover before we call this episode complete?
I don't think so, Brian. You were pretty thorough.
And Christina says, even for using hard money lenders, you need an okay credit score, and that's very true.
Yes.
Yeah, even hard money lenders, and portfolio lenders and other types of real estate investor lenders, they do look at your credit score. Now, granted, they tend to scrutinize the deal and the property a little bit more closely, and they tend to be a little bit more lenient on your credit, but they still set minimum credit requirements and they still price their loans accordingly. So keep that in mind as well. They will charge more for borrowers with bad credit.
Right. I mean, there are loans, especially if your first time in your house hacking, maybe getting a duplex. So you could work with, there are conventional and FHA loans that will work with you with a lower credit score, you know, if you still can get in and it won't be a barrier.
Yeah, and Tim asks here, does that help with getting a new home loan? And I'm not entirely sure which, I'm not sure what you're referring to here. But having just one mortgage on your credit is definitely better for going out and getting a new home loan, like a second home or buying a replacement home, rather than having like 4 mortgages reporting on your credit, if that's what you're referring to, Tim. And of course, higher credit score always makes it easier and cheaper to get a loan, and with a lower down payment. So. Right. All right, guys, thanks as always, and we will see you next Tuesday at 2 o'clock Eastern, 11 a.m. Pacific. And one last comment from Tim. He says, inputting all 3 properties into my LLC while getting a home loan. No, not necessarily. That will not, putting your properties under an LLC name will not necessarily impact your ability to get personal home loans. So yeah, I wouldn't expect that to really impact your ability to get a mortgage for your own personal residence.
Yeah, okay.
But something to talk to your lenders about as you're pricing out loans. So, all right. As always, thanks for joining us, and we will see you next Tuesday.
Have a great day.